There are certain moments in financial markets when something shifts quietly before the public ever senses it. The charts still move. The headlines still debate inflation and demand and industrial supply. Traders still place orders thinking tomorrow will look like yesterday. But behind the scenes, decisions are being made that can change everything overnight. And right now we are approaching one of those moments. Information coming from sources that closely monitor CME Group activity suggests that another margin hike on silver futures is not just being talked about. It is being structured. Documentation is being finalized, internal timing is being coordinated, and the date that continues to surface in separate independent reports is February 21st, 2026. That is 11 days away. If you are holding leveraged silver futures, if you are exposed through options, if you are participating in the paper silver market in any capacity that involves margin, what we are about to discuss is not theoretical. It is practical. It is immediate. And it has the potential to determine whether you protect your capital or watch it vanish in a matter of hours. We already saw how this unfolds. On January 31st, the CME raised silver margin requirements without prior warning. There was no gradual adjustment, no extended notice period. The change came overnight. Traders who were fully compliant at market close suddenly found themselves under margin the next morning. The reaction was swift and brutal. Silver dropped 31% in a single day. Billions of dollars in leveraged positions were liquidated. Accounts that had been profitable for months were erased within hours. Some traders did not just lose profits, they lost principal. Some accounts went negative. Margin calls hit fast. Brokers demanded additional collateral immediately. Those who could not respond quickly enough were forced out at market prices during the collapse. For some individuals, the financial damage extended beyond trading accounts. Savings disappeared, homes were lost, years of accumulated capital evaporated in one trading session. The most painful part is that many believed they were prepared for volatility. They expected price swings. They did not expect the rules governing their leverage to change overnight. And that is the difference. Price movement is one risk. Structural rule changes are another. I am not sharing this to create panic. I am sharing it because timing matters. Once a margin hike is officially announced, the reaction begins instantly. Liquidity thins. Bid and ask spreads widen. Prices can gap before you have time to adjust. Preparation must happen before confirmation, not after. By the end of this discussion, you will clearly understand what a margin hike actually is and why it carries such destructive power. You will understand why the January 31st increase triggered a 31% collapse. You will understand why another hike is reportedly being prepared. You will know the specific timing to monitor. And most importantly, you will know how to position yourself so that you are not forced into liquidation if the announcement comes. Let us start with the mechanics, because this is where most misunderstandings begin. When you trade silver futures on the CME, you are not paying for the full notional value of the contract. You are posting a fraction of it as collateral. That collateral is called margin. It acts as a performance bond. Depending on market conditions, that margin might represent 5 to 15% of the contract's total value. The rest of the exposure is leveraged. Consider a standard silver futures contract. It represents 5,000 ounces. At roughly $82 per ounce, that is more than $400,000 of silver controlled by a fraction of that amount in capital. This is why futures trading is attractive. A relatively small deposit can control a large position. Gains are magnified, but losses are magnified just as aggressively. If you are leveraged 25 to 1, a move of just 4% against your position can eliminate your entire margin, 4%. That is not an extraordinary daily swing in today's silver market. If silver drops 4% and you are long, your equity can be wiped out. If the decline exceeds that threshold, your account can go negative. You receive a margin call. And if you cannot post additional funds immediately, your broker liquidates your position at whatever price is available. This is exactly what unfolded on January 31st. The CME increased margin requirements on silver futures by 37%. Traders who were adequately margined the night before became under-margined the next morning. Thousands received margin calls simultaneously. Most did not have immediate access to additional capital. Positions were liquidated. And when forced selling happens across the market at the same time, prices do not drift lower gradually. They collapse. The initial wave of liquidations drove prices down sharply. That decline triggered additional margin calls. More traders were forced out. Selling accelerated. Each drop created another round of forced exits. It became a cascade. By the end of the session, silver had fallen 31%. Leveraged longs were devastated. Institutions positioned for volatility stepped in and accumulated positions at distressed prices. This pattern is not new. In 2011, silver surged toward $49. A series of margin hikes followed. Each increase reduced leverage and intensified the decline. Prices fell from 49 to 32 in a short period. In 1980, after the Hunt brothers built large positions, margin changes and rule adjustments were implemented. Their positions collapsed. The cycle repeats whenever volatility rises and leverage expands, and that brings us to the present. After the January 31st crash, silver did not stabilize into a calm range. Instead, it rebounded 21% within 10 days. Daily price swings of $5 to $10 became common. Volatility readings climbed to levels not seen since 1980. From a risk management perspective, that environment is unstable. Large price fluctuations increase the probability of clearing member defaults. The CME's clearinghouse must ensure that all trades can be honored. When volatility remains elevated, the exchange reassesses collateral requirements. The CME Group is a publicly traded entity. Its responsibility is to shareholders and to maintaining the integrity of the clearing system. Revenue comes from trading volume and associated fees, but systemic stability is paramount. If volatility threatens that stability, the exchange responds. Historically, that response has been margin increases. Information from analysts who track CME activity indicates that the Risk Management Committee met recently to review silver market conditions. They evaluated volatility metrics, open interest concentrations, and historical precedents. According to multiple independent sources, the committee concluded that current margin levels may be insufficient given sustained volatility. An increase between 25 and 40% in initial margin requirements has reportedly been discussed. The date February 21st aligns with the end of a review period and the beginning of a new margin cycle. Historically, margin changes are announced after market close and implemented the following trading day. If that pattern holds, an announcement could come after the close on February 20th, becoming effective February 21st. I want to be clear about the nature of this information. I am not an insider at the CME. I have not seen official documentation. What I have are reports from independent sources who have accurately anticipated previous margin adjustments, including the January 31st hike. Their track record lends credibility. But there are no guarantees. Dates can shift, decisions can change, the exchange could delay action or implement a smaller adjustment. This is not a call to panic. It is a call to prepare. Preparation means understanding your exposure before any official announcement is made. It means calculating your margin cushion now. It means knowing whether a 40% increase would put you at risk. It means reducing leverage if necessary before liquidity tightens. Because in leveraged markets, the rule changes are often more powerful than the price moves themselves. And when those rules shift overnight, the consequences are immediate. In Part 2, we will break down exactly how to position yourself ahead of a potential February 21st adjustment, how different forms of silver exposure respond to margin hikes, and how some traders are positioning not only to survive volatility, but to capitalize on it. Now let's move from awareness to action. Because information without preparation is useless. If February 21st comes with a margin announcement, the market will not pause so you can think. It will react instantly. And the traders who already adjusted their positions will be operating from a position of control. The traders who waited for confirmation will be reacting in a liquidity vacuum. So the first step is brutally simple. Measure your margin cushion right now. If you are trading silver futures, open your account and look at your available excess margin, not your total account value, not your unrealized gains, your excess margin above maintenance requirements. Then run a stress test. Take the current initial margin requirement and multiply it by 1.4. That simulates a 40% hike. Now ask yourself, if that adjustment happened overnight, would your account still meet requirements? If the answer is no, you are exposed. An exposure in a margin event is not theoretical, it is mechanical. Once the margin requirement increases, brokers issue margin calls immediately. There is no negotiation period. You are either compliant or you are liquidated. And liquidation during a cascading sell-off means accepting whatever price the market is offering at that moment. Remember what happened on January 31st. The 37% margin increase forced thousands of traders into the same position simultaneously. Many could not wire funds fast enough. Positions were sold at market. That selling pushed prices lower, triggering additional margin calls, which forced additional selling. It became self-reinforcing. The initial adjustment was the spark. Leverage was the fuel. If you are leveraged aggressively, even a modest margin increase can put you underwater instantly. And in volatile conditions, price can move sharply before you even receive formal notice from your broker. Now let's talk about options traders. The mechanics differ, but the impact can be just as dramatic. If you are long call options on silver futures or on SLV, you do not face traditional margin calls in the same way futures traders do. Your maximum loss is limited to the premium you paid. That sounds safer, and structurally it is, but your option value is still directly tied to the underlying price. If a margin hike triggers a sudden 20% decline in silver, call premiums can collapse rapidly. Even if volatility spikes, intrinsic value erosion can overwhelm time value. On the other side of the trade are put holders. During the January crash, traders holding put options saw explosive gains. When a market drops 30% in a single session, downside contracts reprice aggressively. Out-of-the-money puts can move into the money instantly. Premiums can multiply several times over. Consider a simplified example. SLV is trading around 22.50. A trader purchases 20 strike puts expiring in March for 50 cents. That is the defined risk. If silver remains stable and no margin hike occurs, those puts likely expire worthless and the 50 cents is lost. But if a margin announcement causes silver to drop 20% and SLV trades down into the high teens, those puts can expand to $3 or $4 in value. That is a multiple return against limited risk. This is why some traders quietly position for volatility events. They understand that structural policy changes create asymmetric opportunity, but this strategy requires discipline. Most options expire worthless. Timing matters, volatility pricing matters, and premium paid must be capital you can afford to lose entirely. Now let's shift to physical silver holders. If you own coins, bars, or allocated bullion, you are not subject to exchange margin policy. There are no overnight collateral adjustments on metal sitting in your possession. If a paper-driven liquidation pushes futures prices lower, your physical ounces remain unchanged. The spot price may decline temporarily, but there is no forced sale. In fact, during previous paper-driven crashes, physical markets have sometimes behaved differently from futures pricing. Retail demand can increase sharply during price drops. Premiums can remain elevated or even rise. Dealers do not always adjust pricing in perfect lockstep with futures markets, particularly when supply is constrained. This divergence becomes visible during stress events. For ETF holders such as SLV or PSLV, the impact is more straightforward. These instruments track the underlying price. If silver drops 20%, your ETF position will reflect that decline. There is no leverage, so there is no liquidation risk, but there is mark-to-market volatility. The real question becomes psychological. Can you hold through a sharp decline triggered by a technical margin adjustment rather than a collapse in fundamentals? Now consider tactical positioning. Some traders are reducing leverage proactively. They are trimming futures positions and locking in gains accumulated during the recent rebound. They are building cash reserves so that if a margin hike triggers another forced selling wave, they can redeploy capital at lower prices. This approach sacrifices potential upside if no hike occurs, but it preserves flexibility. Others are increasing physical holdings ahead of the potential date. Their reasoning is based on supply conditions. COMEX-registered silver inventories have been tight relative to open interest. The LBMA has experienced drawdowns. Shanghai inventories have fluctuated under pressure. If a margin event causes futures prices to drop sharply, physical demand could spike, premiums could widen, availability could tighten further. Buying ahead of that scenario secures supply at known pricing. But we must address probability honestly. The CME faced criticism after the January 31st margin increase. Allegations of manipulation circulated, complaints were filed, political scrutiny increased. If margins are raised again within weeks, the backlash will intensify. The exchange is aware of reputational risk. It must balance clearinghouse stability against public optics. If volatility metrics show signs of cooling, the committee could delay action. If external pressure mounts, alternative risk management tools might be deployed. Position limits could be adjusted. Monitoring could increase. Large participants could receive informal guidance without immediate collateral changes. There is a real possibility that February 21st passes without incident. That scenario must be acknowledged. Acting responsibly means preparing for probability, not assuming certainty. But here is what remains constant. Elevated volatility combined with heavy leverage creates systemic risk. Exchanges historically respond to that risk through margin policy. Whether it is this cycle or the next, margin increases remain part of the structural framework of leveraged commodity markets. You should know today exactly how your portfolio responds to a 25% overnight move. You should know how quickly you can transfer funds. You should know your broker's liquidation policy. These operational details determine survival during volatility events. The larger reality is that the silver market operates on layers of leverage far exceeding physical inventory. There are dozens of paper claims per ounce of registered silver on COMEX. That imbalance makes the system sensitive. Small triggers create outsized reactions. Understanding this structure changes how you trade. It shifts focus from prediction to durability. It forces you to ask not just where price might go, but whether your position can withstand a sudden rule change. If February 21st becomes another inflection point, it will not be random chaos. It will be the predictable interaction between volatility, leverage, and margin policy. Those who reduce excessive leverage now preserve control. Those who ignore margin mechanics gamble on stability in a system that is repeatedly proven unstable. Now we need to step back even further, because focusing only on February 21st misses the deeper reality. Margin hikes are not random attacks on traders. They are pressure valves inside a system built on leverage. And until that system changes, these events will continue to repeat with almost mechanical precision. The silver market, especially on the paper side, is layered with leverage. Futures contracts, option structures, synthetic exposures, algorithmic positioning, all of it rests on collateral rather than full ownership. At any given time, the number of paper claims on silver dramatically exceeds the amount of registered metal available for delivery on COMEX. Estimates regularly suggest there are dozens of paper claims for every ounce of registered silver. That imbalance creates fragility. In a system like that, volatility is not just a price event. It is a structural risk. When price begins to swing aggressively, leverage becomes unstable. A 5% move in a fully paid asset is uncomfortable. A 5% move in a 25 to 1 leverage position is catastrophic. That amplification effect is why margin policy matters so much. The CME does not control global silver supply. It does not control industrial demand. It does not set inflation rates, but it does control margin requirements, and margin requirements determine how much leverage participants can employ. When volatility rises and leverage becomes dangerous, the exchange tightens collateral rules. That tightening reduces exposure, but the process of reducing exposure is often violent. We have seen this repeatedly across decades. In 1980, the Hunt brothers built enormous silver positions. As the price surged, margin rules were adjusted, requirements were increased. The leverage that fueled the rally became unsustainable. Forced liquidation followed. Prices collapsed. In 2011, when silver surged toward $49, a sequence of margin hikes accelerated the reversal. Each increase in required collateral forced more participants to reduce positions. The decline intensified. In January 2026, a 37% margin hike produced a 31% crash in a single day. The pattern is not subtle. It is consistent. Every time leverage builds during a rally, margin adjustments eventually follow. And every time margin adjustments follow, leveraged longs suffer the most. This is why the so-called silver squeeze has been so difficult to execute in the paper market. When price momentum builds and speculative participation increases, margin hikes act as brakes. They force liquidation. Shorts positioned strategically can cover into the decline. The cycle resets. It has happened for decades. Some argue this is coordination between large participants and the exchange. Others argue it is standard risk management. Regardless of interpretation, the outcome remains the same. Leverage is reduced through pain. Now consider what that means for different types of investors. If you are trading futures with high leverage, you are operating inside the most fragile layer of the system. Your position is dependent not only on price direction but also on exchange policy. A rule change can impact you as dramatically as a price move. If you are trading options, your risk is defined, but timing becomes everything. Structural events can create massive opportunity or complete loss depending on positioning. If you are holding ETFs, you are exposed to price, but not to margin mechanics directly. Your challenge is emotional endurance. If you are holding physical silver outright, you are outside the leverage mechanism entirely. There are no margin calls. There is no overnight collateral demand. Your risk is price volatility, not forced liquidation. And here is where the long-term picture matters. Silver is not just a trading instrument. It is an industrial metal with expanding demand in solar energy, electronics, and medical technology. It is also a monetary metal with increasing relevance in a world of growing sovereign debt and currency debasement concerns. At the same time, registered inventories have tightened relative to open interest. COMEX registered silver has approached historically low levels compared to paper claims. The LBMA has experienced inventory drawdowns. Shanghai has shown periodic strain. Physical supply conditions are not infinite, yet short-term pricing remains dominated by leverage dynamics. That is the paradox. Strong long-term fundamentals can coexist with violent short-term collapses because the marginal price is set in a leveraged paper market. Breaking that cycle requires sustained physical demand strong enough to overwhelm paper positioning. Demand that drains inventories. Demand that pressures delivery mechanisms. Demand that forces reconciliation between paper claims and physical availability. Whether that threshold is near or years away remains uncertain. But until it is reached, margin policy will remain a powerful short-term influence. So what should you take away from all of this? First, February 21st is a date worth monitoring. It aligns with margin review cycles. It has appeared in independent reports. It could become the next inflection point, but the lesson is larger than a single calendar event. Second, never operate with leverage that you cannot defend during a sudden rule change. If a 4 or 5% adverse move wipes out your equity, your position size is too large for a volatile market. Third, understand that exchanges protect systemic stability before individual traders. If volatility threatens clearinghouse integrity, margin requirements will increase. That is not conspiracy. It is structural reality. Fourth, Recognize that price collapses triggered by margin hikes do not necessarily reflect fundamental shifts in supply and demand. They often reflect mechanical deleveraging. If a margin hike occurs on February 21st and silver declines sharply, you will see panic. You will see headlines about collapse. You will see forced selling, but you will also see capital rotating. Institutions positioned for volatility will accumulate at lower levels. Traders who preserved liquidity will step in selectively. And once leverage has been flushed out, stability will gradually return. Markets purge excess through stress. Leverage is excess. Margin hikes are the purge mechanism. That does not make them pleasant, but it makes them predictable. The silver market's long-term trajectory will be shaped by industrial demand, monetary conditions, and global economic policy. Short-term price swings will continue to be shaped by leverage and margin dynamics. Your advantage comes from recognizing which layer you are participating in. If you are short-term and leveraged, discipline and capital management determine survival. If you are long-term and unleveraged, patience and conviction determine outcome. February 21st may pass quietly, or it may become another date that traders remember the way they remember January 31st. The difference between damage and opportunity will not depend on prediction. It will depend on preparation. Reduce unnecessary leverage. Maintain liquidity. Understand your exposure. Accept that rules can change overnight, and build your strategy around durability rather than excitement. Because in leveraged commodity markets, survival is the first objective. Profit comes second. Stay alert. Stay disciplined. And approach this market with respect for the mechanics that drive it beneath the surface.